Good afternoon and welcome to our inaugural event, Is Your Portfolio Positioned for a Post-Pandemic World? My name is Derek Cattell and I'm the Director of Wealth and Sales here at Victory Capital, and I will be your host this afternoon. A couple quick items before we start. Please send any questions through the chat feature and we will address them at the end of our prepared remarks. Second, you will receive an email with a replay of this event. So our agenda for this afternoon will start with a few brief introductions, and then we'll move on into our presentation. So again, my name is Derek Cattell. I am the Director of Wealth and Sales at Victory Capital. I started my career at Morgan Stanley and have over 20 years experience serving clients' financial goals. Joining us also this afternoon is Nikhil Sudan, President of the Direct Investor Business. Nikhil is a former partner at McKinsey & Company, where he led the Financial Services Division. Our presenters today will be Scott Kefer, Senior Portfolio Manager. Scott joined Victory Capital in 1999 and has over 25 years portfolio manager experience. Jim Jackson is Head of Fixed Income for USAA Investments and is a graduate of the Naval Academy. After serving in the Marine Corps, Jim has over 20 years investment management experience and joined USAA in 2009. Just want to take a quick second to kind of reintroduce who we are at Victory Capital. We are a diversified global asset manager with over $154 billion in assets. We are traded on the NASDAQ exchange with the ticker VCTR, and we're headquartered here in San Antonio, Texas. The important thing is we are the same people who served you at USAA, and we follow the same mission here at Victory Capital. As part of that mission, we have launched our wealth advisory team to provide concierge investment experience for our clients. We offer one-to-one relationships with our wealth advisors, enabling you to achieve your unique financial goals. The team has over 260 years combined investment experience and includes several CFPs and certified investment management analysts. Today's presentation is just a part of the experience you can expect as a client of the wealth advisory team. Without any further ado, I'd like Scott to get us started talking about the equity market.
Excellent. Thank you, Derek. And I also want to extend my appreciation for everyone joining us this afternoon. So as Derek said, I'm going to talk a little bit about what we're seeing in equity markets and really how we're navigating the current environment. In particular, you're going to hear throughout my presentation this theme of what has been really truly unprecedented monetary and fiscal stimulus, which is now colliding with an economy that's beginning to reopen as more and more people are getting vaccinated and COVID cases continue to decline. This combination of stimulus plus the pent-up demand that's been created over the last year really driving really strong economic growth, which is already starting to show up in increasing corporate profits, but it's also resulting in a shift in the styles and the sectors that are driving equity returns. And we'll walk through some of this in greater detail in the coming slides. And as I said, I'll share some of my thoughts on how to manage through this changing environment. So on this next slide, let's start out by looking at this stimulus that's been pumped into the economy, and start by looking at these four charts you see here on this slide, which I think do a great job providing some perspective on this unprecedented fiscal and monetary stimulus. And keep in mind, these charts are each going back to 2008 and capture some of the response even then from the great financial crisis as well. So if you start in the top left, this is the growth in the money supply. It's a measure of the year-over-year growth in cash and liquid money market instruments. So you can kind of think of it as money on the sidelines, and it's going to provide some insight then as to the buying power of consumers and businesses. So you can see in February, the money supply increased an impressive 27% year over year. Moving to the bottom left, showing us the impact of fiscal stimulus. It's showing the federal budget deficit, which has increased to nearly $4 trillion just in the last year or so, as you see that line really drop. And this reflects, the impact from stimulus checks and tax relief that's been delivered over the last 12 months. You move to the top right, QE, or quantitative easing. And this is a representation of the bond purchases by both the US Federal Reserve as well as the European Central Bank. So showing roughly $8 trillion in combined purchasing of bonds by both central banks. And remember, they buy bonds, that puts cash into the system, into the economy. And then lastly, on the bottom right, you see global short rates, which really reflects the cost to borrow money. So we all know rates are low, but I think this chart also provides some great perspective on just how low and how much rates have come down since '08. So when you look at these four charts, it's pretty clear that monetary and fiscal policy have really combined to create a lot of firepower to drive economic growth. To put this stimulus into the perspective of supply and demand, let me begin by discussing the implications for equity markets that this supply and demand have created. So on the demand side, since the vaccines were first approved in early October, we've really seen the US economy continue on that path to reopening. And when you combine that with pent-up demand and the massive stimulus that we just looked at, there's a really strong case that you can make that economic activity should continue to be strong for the balance of this year and well into next. Now, if you flip to the supply side, conditions are tight. We see very lean inventories that have been even drawn down further during the first quarter. And we're seeing the effect that COVID had disrupting supply chains and disrupting manufacturing in certain areas of the economy. For example, you may have read about semiconductor shortages, and they've really stemmed from factories that had to shut down during COVID. It's had a major ripple effect through lots of other industries. We're seeing it impact auto manufacturing and cell phone production. And we're seeing similar supply disruptions in other parts of the economy as well. So we have strong demand, we have tight supply. What are some of those implications? Well, for starters, it's already translating into really robust economic growth. In the US, we're seeing a consumer that's very strong. We're seeing consumer confidence readings that are very high. Consumer net worth has grown substantially over the last year, and it's beginning to translate into stronger retail sales figures. Additionally, we're seeing a very strong housing market as well. And on the manufacturing side, we have inventories now that need to be replenished. And PMIs, which are an important leading indicator, have also come in really strong. So clearly, strong demand, tight supply. We have to be mindful of inflation and rising interest rates. But assuming we only see a modest or a gradual increase in rates and that inflation also proves to be somewhat modest and transitory, it's not necessarily a bad thing for stocks. It just makes certain stocks and certain sectors and certain styles potentially more attractive than others. So all of this is to simply say that we remain very constructive on equities, and that vaccines plus stimulus plus pent-up demand has moved us into a new expansionary phase of the economic cycle, which we'll take a look at on this slide. So, go back, I'm sorry. So on this slide, we're looking at the economic cycle, and it's showing the four phases of the economic cycle. And at the bottom, you can see the equity styles that tend to do best during each of these phases. So clearly, COVID put us into that defensive phase of the cycle for most of last year, that grayish box in the middle. And in a defensive period like that, you tend to see higher quality, stocks with lower volatility, and oftentimes growth stocks that tend to do best in that defensive environment. And often I'm asked why growth stocks do well in a defensive period or a slowdown type of period. This is marked on this chart. Well, it's because when economic growth is weak, there's actually a scarcity value and a premium placed on companies that can still grow their earnings in a slowing or uncertain economic climate. And as a result, growth stocks tend to outperform in that phase of the cycle. And we remained in that defensive part of the cycle until really early October. But then the first vaccines rolled out and things really began to change. And we began to move into the right side of this chart, into that heating up part of the cycle. And in this, what is more of a pro-cyclical regime, you start seeing things like value stocks, momentum, companies that are smaller size really start to do best. And it's exactly what we've seen over the last 6 months and exactly what we expect to continue to see as we look out and look forward. So let's take a look at this regime shift we experienced last year on this next slide. Okay, so on this slide, as I said, we can now pinpoint that the beginning of this regime shift really started when those first vaccines got approved in October. But let's start by looking at the asset classes that did best prior to the vaccines getting approved. So in this chart, we're looking at the best performing asset classes in the start of 2020, so the first 9 months of the year. And we're looking at them compared to their 10-year or their long-term average returns. And what you see is the best performing asset classes at the top of this chart were more defensive. Again, US large cap growth stocks were the best performing asset class in the first 9 months of last year, up 24%, significantly ahead of their 10-year average return. And given the flight to safety that we saw last year and the decline in rates, we also saw fixed income do very well, as you can see in the return to the longer dated treasuries in the US aggregate bond index. Meanwhile, though, the asset classes like emerging markets, EFA or international equities, small cap stocks, and large value materially underperformed their long-term averages. Well, then came the COVID vaccines, as I said, and things began to change dramatically, and we'll see that on the next slide. So here's the same chart, but for the last 6 months. So since September 30th of last year through the end of the first quarter, March 31st of this year. And you see a complete reversal, a complete regime shift. Now in green, you can see the worst performing asset classes from the first 9 months of last year are now the best performing asset classes over the last 6 months. And the best performers from early last year, well, they now lag. So over the last 6 months, it's now small caps that are the best performing asset class. They're materially outperforming large cap growth stocks, and even large cap value is also doing very well now, as are emerging market and the international or EFA stocks. So why is that occurring? Well, again, vaccines plus the stimulus plus the pent-up demand has moved us into this expansion, this pro-cyclical phase, and we're really starting to see markets reward these asset classes that have that greater cyclical exposure. Go to the next slide. So this regime shift is also having implications on market cap weighted indexes like the S&P 500. Market cap weighted index meaning that companies that weight the positions within their index by size, largest companies, largest weights. And what we saw last year was that the concentration in the S&P 500 reached levels we hadn't seen since the 1970s. And back then in the 70s, it was the major oil companies that were the dominant weights in the index. Today, it's obviously those mega cap growth names. So companies like Apple, Microsoft, Amazon, Facebook, and Google. These 5 alone represent over 20% of the S&P 500's weight, index weight. And given that large weight, their performance plays a very significant role in the outcome or the overall return of the index. So concentration can be a great tailwind, clearly, when those names are outperforming, those concentrated names. But if they lag, it can also become a headwind. So let's take a look at that on the next slide. So here again, I'm going to start by looking at what was working in the first 9 months of last year. So for the first 9 months of last year, again, large cap growth was that best performing asset class. We saw that earlier. But in this chart, what we're doing is we're deconstructing the S&P 500's 5.58% return that you see in red here for the first 9 months of last year. And then in blue, we see the return of the top 5 positions. So again, Apple, Microsoft, Amazon, Facebook, Google. They were up a remarkable 45% in the first 9 months of last year. These 5 heavyweights dramatically outperformed the other 495 stocks in the S&P. Those stocks were actually down 1.5% in the first 9 months. You can see that in green. So clearly concentrated weight in these mega cap tech names were a great tailwind and clearly helped the S&P in the first 9 months of last year. But on the next slide, you're going to see once again that regime shift. Here we look at the performance of the S&P 500 over the last 6 months. So again, since the end of September and since the vaccines, and things completely reversed. Now it's the other 495 stocks, the green line. They're carrying the return of the S&P 500. They're up over 21%. And now it's the top 5 stocks that are lagging. They're up only 9%. So the point here is market cap weighted indexes, they could struggle versus more diversified approaches that provide greater exposure to all 500 or to the other 495 stocks in an index like the S&P. More specifically, approaches that offer greater exposure to cyclical sectors, smaller size companies, those are the ones that should and could continue to outperform. So we've seen these cycles of concentration before. This is a great chart that shows the rolling 1-year returns of the largest 10 companies in the S&P 500 and compares it to the returns of the other 490 stocks in the index. And this goes back to 1991. And the easiest way to interpret this slide is that when you see one of these turquoise mountains, the top 10 stocks are outperforming. A purple valley means the other 490 stocks are outperforming. Higher the mountain, deeper the valley is just the greater the magnitude of outperformance. Now, what you notice is that we've had really 2 major cycles of concentration in this time period. The first, not too surprising, occurred in the mid to late 1990s during the dot-com era. And the second cycle occurred really over the last 5 years, all the way to the right. Now, notably, this more recent cycle last year, that cycle materially eclipsed the cycle of concentration we saw in the 90s in terms of the outperformance. During this period, we see the top 10 outperformed the other 490 by 41%. The height of the tech bubble, the top 10 only outperformed by less than 19%. Now, if you take a look to the data point furthest to the right on the chart, that negative 1.6, it shows that we've come off this cycle of concentration and how fast we've since come off for some of the things I spoke about earlier. In other words, the bottom 490 stocks are really beginning to outperform the top 10. Begs the question, could this be the beginning of another purple valley? Something similar to what we saw when we exited the last cycle of concentration in the 90s. And again, if that is to occur, a more diversified approach will likely outperform a concentrated cap weight index. All right, so we've talked about this regime shift in terms of asset classes. We've talked about it in terms of the concentration in cap weighted indexes. Let's take a look at sector performance, again, in the before and after kind of lens. So in the left, we're going to look at the performance of these sectors during the first 9 months of last year. And then on the right, after the vaccines, the regime shift, we can see what happened to these sectors on the right in the last 6 months. So in the first 9 months on the left, the best performing sectors were tech, consumer discretionary, communication services, each materially outperforming. Now look at the regime shift on the right side, the last 6 months. The best performing sectors, some of the worst performers in the first 9 months of last year. You see energy up 67%, financials up 43%, industrials, materials. Each of these are representing more pro-cyclical sectors and all likely beneficiaries of the macro backdrop that we discussed earlier. Now, the next slide is one of my favorites, a good long-term perspective on what's been going on. This chart shows the composition of the S&P 500 and looks at its sector decomposition in 2 buckets, growth in defensive sectors versus its exposure to cyclical sectors. And this one goes all the way back to 1925. The orange line represents those growth and defensive sectors. So subsectors, as you can see on the bottom, like technology, communication services, healthcare, consumer. The green line are those cyclical sectors, so financials, industrials, materials, and energy. What this chart really shows is that the orange line, those growth and defensive sectors, are now 80% of the weight in the S&P 500. 80%, an all-time high. And meanwhile, the green line, those cyclical sectors, have been reduced to just 20% of the S&P 500, an all-time low. And this greatly exceeds, again, what we saw during the peak in the tech bubble when that orange line got to about 70%. But you also don't have to go back too far to find that this split had historically been around 60-40. So as we discussed earlier in the presentation, growth in defensive sectors, they can tend to do best when there's less certainty in the overall economic picture, the growth picture. And it's why you really saw these 2 lines begin deviating soon after the great financial crisis in 2008. And then if you look closely, it's why these lines really blew out, almost went vertical when COVID shut the economy down last year. But now in the rightmost part of the chart, you're beginning to see these lines start to hook back toward each other. This is again because pro-cyclical rally started late last year. And I'm not here to suggest these lines are going to converge, but if this cyclical rally continues as we suspect, once again, a strategy with greater diversification and greater exposure to these sort of cyclical sectors has that potential to outperform. Okay, on this next slide, we'll look a little bit at the value versus growth dynamic in equities. And I'm not going to spend too much time on this topic, other than to say that we've seen these cycles of value versus growth throughout history as well. And this chart goes back to 1980, looks at the cumulative excess return of each style. And the point here is that we've seen periods where growth is outperformed for multi-year stretches, followed by periods where value is outperformed. So nothing new in terms of that. But as you can see here too, on the furthest to the right, these lines are beginning to converge. This is consistent with the slide I showed earlier that pointed to the strong performance of large cap value over the last 6 months. It's also consistent with my comments about growth, that it tends to do well during the defensive part of the cycle. It's also consistent with the sector performance slide we just looked at too, because value tends to offer greater exposure to more cyclically sensitive sectors, whether they be industrials, financials, material, and energy. They tend to be larger weights in value indexes, whereas technology tends to be a lighter weight. So last part of the equity conversation we'll have is on this next slide, we take a look at US stocks versus non-US. And here too, we see similar cycles over time. I apologize, there's a lot of data on this slide, but to keep it simple, if you just simply look at the 4 quadrants on this slide, you start on the top left, you can see from 1988 to 1993, we had a great run for emerging markets. This was followed in the top right by the great tech and .com rally we saw in the 90s that clearly favored US stocks. When the bubble burst, and you see this in the bottom left, we saw both international and emerging stocks outperform the S&P for a decade, from 2000 to 2009. And then this last decade, US stocks once again had a period of great outperformance. Now, keep in mind what I mentioned earlier. We've seen international and emerging stocks begin to outperform over the last 6 months. And the reason, they too are benefiting from vaccines, plus stimulus, plus pent-up demand. Additionally, these areas tend to be relatively more attractive from a valuation standpoint, tend to be cheaper than US stocks. And emerging markets in particular tends to offer a more cyclical exposure than US stocks. So both therefore fit that style and asset class exposure that we think should continue to do well in a pro-cyclical phase of the economy. And maybe more importantly, many investors are likely underweight these asset classes given their relative underperformance over the last few years. So I'm going to wrap things up on this next slide, try to provide a quick summary of the styles and exposures we're favoring in this post-pandemic environment. And again, much of this is predicated on that idea that vaccines plus stimulus plus pent-up demand puts us in that pro-cyclical part of the cycle. In this part of the cycle, we expect to see continued robust economic growth. We continue to expect to see very strong corporate profits, much like we just experienced with these companies reporting their first quarter results, which dramatically exceeded expectations. And in this environment, we're going to favor strategies that offer increased diversification, that avoid the concentration risk that can occur in cap-weighted indexes, that mega cap concentration. And because we believe we're in this pro-cyclical part of the cycle, we're going to favor strategies that offer greater exposure to cyclicals and to value. We also like strategies that focus on dividends, not only for their income potential, but also because high dividend strategies in particular often have more of a value style tilt to them. So fitting our other theme that we're favoring right now. And then lastly, and probably a good transition to Jim, within fixed income, we do favor an actively managed approach with a team like Jim's that really has a yield or an income focus in their methodology. So with that, I'm going to pass the mic to my partner, Jim Jackson, head of fixed income for USAA's investments. Jim?
Thanks, Scott. My goal in the next 10 minutes or so is to relate to some of the items Scott covered to the fixed income markets and to add some insights that are unique to bonds that weren't covered in Scott's portion of the presentation. So first, I would like to start with defining the post-pandemic world as it relates to fixed income. The increase in interest rates in the first quarter highlighted the impact of interest rate risk on fixed income portfolios. The increase in rates driven by factors that Scott touched on, such as greater fiscal spending and looser monetary policy, added to the other forces that drove rates higher in the first quarter. And those would include inflation and GDP growth expectations that have increased and increasing earnings estimates for U.S. corporates. So the short story is that economic activity and earnings are growing faster than was expected even a few months ago. So as you can see from the next slide, the first quarter of 2001 saw an increase in interest rates across most of the Treasury curve, highlighting interest rate risk. So the chart on your left is the U.S. Treasury curve at the end of 2020, which is the purple line, and at the end of the first quarter, which is the blue line. The Treasury curve plots the interest rates of Treasury bonds across the various term structure of the bonds and shows the relationship between interest rates and maturities. When interest rates increase, bond prices fall, all else being equal. And the magnitude of the price movement is driven by duration, a measure of interest rate sensitivity. So the chart on the right demonstrates the return of the Bloomberg Barclays US Aggregate Index decomposed by duration. So as you can see, the longer the duration, the larger the price decline during the first quarter. Next slide, please. So this chart shows one measure of the increase in inflation expectations, and this is called the 5-year break-even inflation rate, which is calculated by subtracting the 5-year TIPS rate from the 5-year Treasury rate. So the quarter saw a clear rise in expectations, although I would point out that the expectations, although higher, are still somewhat muted at around 2.5% over the next 5 years. So the way to think about this is what this chart is showing you, that from market-based metrics, that the expected inflation rate over the next 5 years is roughly 2.5%. So although this is higher than we would have seen over the last year, it is certainly not enough where you would change the basic outlines of your portfolio. The final point from this slide is that when we start to see inflation expectations rise, we tend to see bond yields rise. Next slide, please. So the basic characteristics of the post-pandemic world can be rounded out by looking at these two charts. So during the first quarter, we saw the Federal Reserve Bank increase its 2021 GDP growth expectations, as seen on the chart on the left. So at their meeting at the end of 2020, the Federal Reserve's expectations for GDP growth in 2021 were 4.2%. Fast forward to their March meeting, and they increased that expectation to 6.5%. So the Fed, at least, is expecting stronger economic growth throughout this year. The chart on the right shows corporate earnings estimates. So this chart basically will take you from the end of 2019 through the current time period. So it shows how quickly earnings estimates fell after the onset of COVID in March of 2020. But what it also is showing, particularly in the last quarter, is that earnings estimates for corporates are inching higher for 2021. So not only is the Fed expecting stronger growth, corporations are expecting that stronger growth to lead to higher profits, and that number has been increasing over time. Next slide, please. So what does this mean for fixed income investors? Investors need to ensure that their interest rate risk matches their risk tolerance. Longer duration tends to be correlated with higher yields, but the trade-off is greater exposure to interest rate risk. We also think there are other ways to mitigate the risk of rising rates. First is to invest in what we call spread product, or bonds where you are compensated for taking credit risk. Second, it is to limit your exposure to agency mortgage-backed securities, which have characteristics that could increase your interest rate risk if rates rise. Finally, follow a consistent strategy. We have seen little evidence that anyone can predict interest rates, so we think it is best to establish the risk parameters for your fixed income holdings and stay consistent with that strategy. This chart shows the relationship between the 10-year Treasury yield and credit spreads during the first quarter of 2021. So credit spreads are defined as the additional compensation you receive for taking credit risk, measured here by the spread on the Bloomberg Barclays US Corporate Index. So the yield on a fixed income portfolio will consist of the yield on the Treasury bonds plus the credit spread. So as you can see, during the first quarter, when Treasury rates increased, corporate spreads were flat. So the impact of the increase in rates was muted somewhat by flat credit spreads. The dynamic shown on the previous slide is consistent with what we have seen historically. On this chart, we look at the last 7 periods where rates rose year over year and the returns of the Bloomberg Barclays US Aggregate 5 to 7 year index. So we narrowed this down to the 5 to 7 year index so that we could keep duration relatively constant through this work. So what we did then is we compared the returns of the aggregate index to the Treasury index and also to the corporate index. And what we found is that when rates increased, the index that had credit exposure outperformed Treasury bonds. So we refer to this dynamic as Treasury rates being negatively correlated to credit spreads. So historically, when Treasury rates go up, credit spreads don't follow. The next slide refers, next slide, please. One of the strategic allocations we have in our fixed income portfolios is limited exposure to agency mortgage-backed securities relative to the market. Agency MBS are bonds issued by Ginnie Mae, Fannie Mae, or Freddie Mac, and they are pools of home loans that are packaged together and sold to bond investors to put in fixed income portfolios. So these bonds have prepayment features that we view as unfavorable. When rates increase, these bonds extend. So the duration risk of the bonds, or the interest rate risk of the bonds, increases as rates go up. So an example of this is just thinking about your own home loan. So if rates go up and you have a low rate mortgage, you're not going to refinance that loan. You're going to keep it outstanding for as long as possible. When rates go down, you obviously refi that loan and the loan gets taken out. Well, the same sort of thing happens with this bond. So when rates go up, homeowners tend to prepay their loans at a slower pace. The duration risk of these bonds extends, and as a bondholder, you are stuck with a lower yielding bond. So this is a type of security that we strategically underweight across our platform. So what are the key takeaways for fixed income? Well, first is to ensure that the duration of your fixed income portfolio matches your risk tolerance. So we manage our fixed income portfolios to duration targets based off of the fund's benchmarks. So when you're using our funds for your fixed income portfolio, you can be confident that we are not looking to generate relative returns by making interest rate bets relative to the benchmark. Second, we focus on income. We think this is the primary driver of fixed income returns over time. Third, we underweight agency MBS due to the unfavorable prepayment characteristics. Fourth, we follow a consistent, disciplined strategy that has steered us through many different credit and macroeconomic cycles. So that ends my prepared remarks. I'd like to thank you for your time and for entrusting us with your fixed income holdings.
Got it. With that, we do have some time for questions. So we did get a couple of questions early on. So one of them is, the question that's been fairly common is, when do you think interest rates will begin moving higher? There's reports that if the government spending plans go into effect, that it could work to overheat the economy. So I think that actually goes to both Jim and Scott. If you'd kind of touch on that and what you feel the government spending impact could be.
Scott, I can start with that if you don't mind. So what has happened already is we've already started to see interest rates move higher with the expectations of stronger economic growth and the increase in inflation expectations. For what we would need to move rates higher is for inflation to average higher than the Fed's target, and for unemployment to continue to fall and to fall sort of either at to or below the Fed's target. I would caution, though, that interest rates are driven by any number of factors, so that even hitting these targets doesn't guarantee that rates will move up much. So the one consistent from the Fed is that its intent is to keep short rates low until inflation and unemployment hit their targets. The other aspect of that question is what is the outlook for inflation. I think that the interest rate question and the inflation question are hand in hand here. So interest rate expectations, as I've shown, they've already started to move higher. I would emphasize that expectations, although higher, are not at levels where it should impact how you're managing your portfolio. I would emphasize also to look at the data. So there are at least three ways that I look at inflation expectations. The first would be market-based. As I showed in one of my slides, at the 5-year break-even rate right now is approximately 2.6%, which is not exactly a dire inflation situation. The second way to look at it is from consumer survey data. So the latest Michigan survey data has revealed that consumers expect 12-month inflation of 3.4%, yet they expect 5 to 10-year inflation of 2.7%. So again, higher than it has been for the last year, but certainly not an out of control level. And then the final way is to look at what economists are, what they are forecasting. So the latest survey from Bloomberg indicates that a group of economists are expecting inflation in 2021 to be 2.5% and 2.1% in 2022. So although this is a concern and inflation is always a risk in any portfolio, the current survey of expectations indicate that it is currently not at a level or expected to be at a level that is significantly worrisome.
I don't have a lot to add to what Jim said. I tend to agree. I think the consensus estimates have the Fed staying on hold through all of next year. That can obviously change. I think this is the key question. Is the big fear would be that the Fed gets behind and is too late to react. And you saw comments from Janet Yellen yesterday kind of implying that she thinks the dovish stance might be a little bit too dovish. But I think that will all remain to be seen. The two variables, they haven't hit their targets, as Jim said. Inflation and employment are still not at their target, and they've made it clear they want to let it run hot for a little bit and to see whether it's transient. And whether it's transient inflation is going to really depend on how wages react. We don't want to see wages start to tick up too fast in response to this when labor markets are tight. And really important, what a lot of economists are looking at is to see whether companies can gain productivity to enhance their profitability to be able to absorb any rising input costs until we get through this sort of transitory phase of inflation. So there are a lot of variables to still be sorted out. Again, consensus estimates are for rates to stay on hold through all of next year. I do think that this will be a back and forth conversation and market reaction, for the next few quarters. But I do believe neither will, spiral out of control, for example. And it would be very easy for the Fed to just change their tone, change their posture, and start a reaction even before they actually pulled the trigger and did any kind of changing in rates.
Got it. Our next question is along the same lines of inflation. And so I think this one's a little bit more for you, Scott, which is, didn't hear you mention a whole lot about any opportunities in precious metals. So is that still something that could work as a potential counter to some inflationary pressures?
Yeah, definitely. We do still like precious metals. The precious metals did pretty well late last year, and then they sort of cooled off a bit. They've started to come back a little bit more recently. You've definitely seen a better reaction in sort of the base metals, the coppers and the iron ores that are a little bit more tied cyclically as inputs to the economy, whereas some of the precious metals are still influenced by literally the demand for jewelry and things like that, which have been a little bit softer. But we still like that as an inflation hedge. You have negative real rates right now. It's typically when those precious metals do better. And again, we've started to see them come back a bit. So we definitely like having exposure to precious metals in your asset allocation right now.
Thank you. Again, I just want to remind the audience that if you have any additional questions, please put that in the chat box, and then we will be able to get that asked to Jim and Scott. Another question for both of you is, how does tax policy affect interest rates and stock valuations? There have been news reports about potential increases in not just individual income tax rates, but also corporately. So what impact does that have in both the fixed income and the equity world?
I'm sorry, the two things were taxes and
how does tax policy affect interest rates and stock valuations?
okay, sure. I mean, I'll start. Taxes are an expense. So the question then becomes, as it fits into this whole macro picture, is it an expense these companies can absorb? And that comes back to that idea of, can they gain additional productivity? Or is it a cost that they pass on, which then becomes prices go up, it becomes inflationary. So it has to be viewed through the lens of it being an expense from an equity side. That's how we would view it. It impacts, your net income. So we will be mindful of that and see how that ultimately plays out. It's being offset not only from productivity gains at these companies, it's also being offset by higher revenues, and that driving some margin leverage for these companies also to help absorb it. We don't think that there's going to be a massive opportunity for them to pass those rising costs off to consumers, but that would be something we definitely would keep an eye on.
And one last.
With regards to,
I'm sorry, Jim. Go ahead.
With regards to interest rates, I don't think there's any direct line or causation you can apply to tax policy regarding the movement of rates. I think the overall interest rate environment is too complex with too many variables to single it down to one tax policy or any country's tax policy. The one thing I would say is what we've seen on the fixed income side is that the market expectation is that tax rates will be higher. And what we have seen is very strong performance in the tax exempt market, driven by the expected higher tax rate. So we have seen the expected tax policy drive some sort of basis in returns between taxable bonds and tax exempt bonds, but that was driven more by the tax exempt status of the muni funds more than the overall interest rate environment.
Thanks, Jim. One last question, something that's been rather popular of late is crypto. So do either one of you have an opinion on cryptocurrency as an investment or asset class?
I'm smiling. I don't have a strong case for it. I think it is, it is being viewed as a means of as an asset class, as a means of stored value. So I'm not surprised it's going up with the liquidity in the system, but I don't have a strong case for crypto. It's not something that we currently invest with or invest in.
I don't have any opinion on crypto other than I would state that I think it's further validation for a diverse portfolio of stocks and bonds that generate income for shareholders that have a long track record measured in centuries that you can have confidence in.